Yes, the worst is over. I like Mike Lyons, the fever has broken. Doesn't mean it's back to normal. We're going to have more volatility. I think the last 2 days were big-time attempts at finding the bottom in volatility, in forced selling, in deleveraging, in taking risk parity kinds of portfolios back to normal. We will get back to fundamentals. Fundamentals are not the same as they were. Interest rates are higher, volatility is going to be a little higher, but earnings are still fantastic.
Can I ask you a very simple question? After all, it's over, the fever's broken, the protocol has been discussed. Are investors in 6 months going to be willing to pay 17 times or 16 times? Because if they're going to only pay 16 times the historical norm, we've got another 14% down.
Yeah, I think 17 is probably more like it, but that's not where we were. We make these 10 predictions every year. Our view is the end of the year, PE will be lower than January 1st. The first time in 7 years. We've had 6 straight years where the stock market has gone up more than earnings. PEs have gone up. This year they're going to come down.
So you're a
some.
17 times guy by the end of 2018. You're comfortable with that, with a three handle on the 10-year. That's the way the world's going to work. The rest of this stuff is just noise. That, at the end of the day,
it's noise, but it's an adjustment. It's adjustment from where we've been for a long time. Low vol, very low PE, very low interest rates, very low inflation, high PEs. We're just going to adjust that some to a more normal environment, if we can remember that.
Well, the last couple of days was an adjustment. I mean, let's get the chiropractor in. Brian, what do you think?
So investors have been clamoring for a correction for a while now, and 2017 was the first year in a very long time we didn't have a greater than 5% correction, so it just came a couple of weeks later. When I would get concerned about markets, I mean, I have a little dashboard that I look at. I would see inflation significantly higher in the United States. I would see a Fed raising interest rates and long rates coming down, converging with short rates. I would see credit spreads blowing out. I would see a stronger dollar, a significantly stronger dollar, not just the last couple of days. So these types of moves don't particularly concern me. I agree with Bob. This is a new paradigm, but this isn't one that looks like the end of a cycle. Investors should see through this volatility, and stocks are likely to be higher 1-2 years out.
What's your underlying assumption about what the 10-year is going to be in the next 6 months?
So I would not be surprised to see the 10-year continue to creep higher. But if you were to say to me over a sustained period, do interest rates stay at 3% or move closer to 2%? I would say closer to 2% because of high savings rates around the world, because of an aging population. So I think we can see 3%, but I don't think we're sustained there. I would still be in the low for long camp.
Jim Caron, you're a fixed income guy. You tell me, what do you think is going on with the 10-year? Where's it going?
Sure. So I think that whenever these events happen, that there are 2 questions. One is what have we learned, and 2 is what are the questions that we have to ask going forward. What we learned, I think, is that the low rate, low volatility environment has probably come to an end. And that's just really the ending stages of quantitative easing. And this is happening in a slow process. What this effectively does when you end QE or when you move into this stage, what QE did is it depressed interest rates, it depressed volatility, it depressed risk premia to reflate asset prices. That's what happened. That is now slowly starting to turn and slowly starting to come to an end. And what asset prices are doing is they're trying to find that next level of risk premium. So, Kevin was discussing, what's the multiple the market's trying to pay? That's the right question. Bob was just talking about, at what level of interest rates do we think that we can settle at? What's the new range? I think these are the right questions to ask. And I would argue that the range in the 10-year is probably more closer to the 250 to 325 as opposed to the 2 to 2.5%. And that we're just going to readjust to this. And in that process of readjustment and in that process of risk premium readjustment, that's when we're going to find the new levels and the new ranges, and that's where value will be.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.